As the recession combined with sky-high inflation wreaks havoc on the American economy, consumers and investors alike are anxious for solutions. The Fed has remained steadfast in its goal to bring inflation back to 2%, but Cathie Wood believes that they might be overdoing it. Cathie Wood is an American investor and the CEO of Ark Invest, an investment management firm with nearly $15 billion worth of assets under management. Cathie Wood gives her 2 cents on the current economic climate as well as the Fed's performance in bringing down inflation. We've done videos about Cathie Wood in the past, as she has previously called the Fed out on their policies. So today, we'll be hearing more about her thoughts on all this. Thanks for continuing to support our channel. Let's get right into the video.
There's a big debate as to whether we're in one or not. And I know there are perhaps political dynamics at work suggesting that no one wants a recession in a midterm election year. But we believe we're in a recession, and I think the evidence is accumulating that the statistics that we're getting fed day to day and to which the market reacts so violently may be very distorted by seasonal factors. And I'll get into that in a moment. But if we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, usually fiscal stimulus and monetary stimulus follow pretty quickly. And instead, what we're getting now is the opposite: fiscal policy tightening, including the Inflation Reduction Act, and monetary policy tightening, and tightening aggressively.
In this first clip, Cathie Wood first states that the 2 previous quarters that showed negative GDP growth in the US might be much worse than what is being reported to the public. She says that the previous data may have been a little distorted due to seasonal factors that would have affected the data from the previous 2 quarters. The next point she discusses is how severe inflation will be in 2022. She also says that no expert could have predicted that the supply chain issues that started at the beginning of the pandemic in 2020 would go on for 2 more years. There is some positive, however, as Cathie says that she believes these supply chain issues are beginning to fade as we move towards the end of the 3rd quarter of 2022. She also mentions the war in Ukraine, which led to food and energy prices soaring to sky-high levels. Cathie also notes a unique characteristic about this recession. She says that in most recessions, money is given away to stimulate the economy. However, in this recession, the Fed is tightening up monetary and fiscal policies. In this next clip, Cathie discusses fiscal policies.
Fiscal policy. We got the Inflation Reduction Act, and as I think many studies have corroborated, the initial University of Pennsylvania analysis was that it would not reduce inflation per se. And yet, we probably will see lower inflation. So, I think that the administration will take the credit for that. And frankly, all I care about is that inflation unwinds. But to understand the pro-cyclical nature of this policy, taxes will go up, now this is over a 10-year period, by $737 billion, and spending will go up by $437 billion, thereby reducing the deficit. Now, if that were correct, and I don't think it will be, these numbers are never really correct, but if that were correct, the deficit would be shrinking. And we do know that federal outlays still are down 15% year over year. So that gets into our GDP accounts, and government accounts for 20% of our GDP. So down 15% in 20% of the economy, that is fiscal drag and is contributing to the recession.
In this clip, Cathie Wood first talks about the Inflation Reduction Act. She states that despite studies done by experts saying that this will be ineffective in taming down, the law has a good chance of reducing inflation in the United States. Cathie also says that taxes and consumer spending will increase considerably over the next 10 years. She also points to another factor contributing to the recession, which is federal outlays or the payout of federal cash. Cathie says that this is down 15% and accounts for 20% of the economy, meaning it contributes to the current recession. In this next clip, Cathie discusses monetary policy.
Chairman Powell gave his annual presentation at Jackson Hole, or gave the Fed's annual presentation. We read line by line what he said, and it was very interesting. He invoked the name of Volcker, former Federal Reserve Chairman Volcker, who really combated the inflation of the late 70s and early 80s. He invoked his name twice, but he also hinted by using the phrase keep at it or keeping at it twice. So that was really a reference to the late 70s, early 80s. And I really do believe that the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation. As we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08-09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change in 2017-18. And then they had to rein it back in because at the end of 2018, the economy looked like it was going to fall apart. And then of course in 2020 we had COVID. Nonetheless, for most of the last decade, very low interest rates, very little movement in interest rates, and now all of a sudden, a tenfold increase in short-term interest rates. Many people are using the level of interest rates to suggest that this is not really tight monetary policy. It's only 2.5% on the interest rate. But I really believe that change has been a tremendous shock to our system and certainly to housing. We're seeing statistics, and I'll go into them in a moment, all over the place, that housing is in a recession. And I do believe we're seeing evidence that prices are going to follow. We're concerned that the Fed's overdoing it, and that in invoking Volcker's name twice, outright, and then indirectly twice, that Chairman Powell was basically going to say, we're keeping at it, and we almost don't care what happens to the economy. And in the statement, it was very interesting. There was no focus on real economic activity. The only focus was on inflation. So that was a clear message. We don't care. We just want 2% inflation. Now, the reason this is so important from an investor's point of view is if you look at valuation, so PE ratios in the 70s and early 80s, I think they bottomed out somewhere between the 6 and 7 times range, 6 or 7 times earnings. And I believe that was in 1982. And that was because inflation had been ingrained, and the discount rates, I mean, we were at a double-digit interest rate, so valuations should have been that low. Now, many people believe, certainly the bears do, that we are back in a 70s environment. And that is why they're very negative on the equity market, because today the PE ratio of the S&P 500, assuming $200 for S&P earnings this year, and I actually think that's too aggressive, but that's close to the consensus estimate. The S&P 500 is selling closer to 20 times. So many people who are seeing another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes. But we don't think it's going to stay there. And I think that most of the people who believe we're going back into a 70s environment think that interest rates are going to double and then double again from there. If they do not, if these interest rates do not continue to move up, and we do not think they will, the long-term Treasury rate, I'm not talking about the short-term, that's more governed by the Fed policy directly. The long-term inflation rate is more focused on the next 10 years growth and inflation outlook. And so far it's saying that anyone thinking we're back in the 70s.
Cathie gives her thoughts on Fed Chair Jerome Powell's recent speech. Cathie points out how Powell mentioned the name of the former Fed Chair Paul Volcker, who handled the inflationary situation of the 1980s. She says that this means the Fed recognizes that the problem is just as significant as the 1970s and 1980s, and that they don't want to be known as the Federal Reserve staff who had to oversee another big inflation situation. Cathie Wood says that this inflation is mainly connected to the COVID pandemic and its economic effects. According to her, the Fed is so paranoid about this inflation that they raised the Federal Reserve Fed fund rates from 0.25% to 2.5%, a tenfold increase that occurred in only half a year. This behavior is uncharacteristic of the Fed, as they have never adjusted interest rates this much over the past decade. Cathie says that although some people downplay the effect of these interest rates, its effects are obvious, especially in the housing market, which is currently in a recession as well. Moreover, Cathie is concerned that the Fed may be exaggerating its fight against inflation. She says that there is a possibility that the Fed does not care what happens to the economy, as long as inflation goes back down to 2%. Lastly, Cathie states that many people believe that our economy is in a similar situation as the 1970s, but she claims that the bond market for the 1970s and now are very different. Back in the 1970s, bond yields kept going up, but today, it barely even goes above 3%. Cathie concludes by saying that those who think we are back in the 70s are wrong, and this is backed up by growth and inflation outlook data over the next 10 years. In this video, Cathie Wood states that she believes this inflation is primarily due to the COVID outbreak and its adverse effects on the economy, specifically the supply chains. Cathie Wood also breaks down Fed Chair Jerome Powell's recent Jackson Hole speech, adding that the Fed might be willing to do anything just to get inflation down, including crashing the whole economy. She also gives credit to the Inflation Reduction Act, which she believes will help tone down inflation. Finally, Cathie Wood assures us that it is unlikely that we are back to the same economic climate of the 1970s and 80s. What did you guys think of Cathie Wood's analysis? How would you evaluate the Fed's performance so far? Give us your insights in the comments section down below. If you enjoyed this video, kindly like and subscribe. And we'll catch you on the next one.